The stock market can help you make a lot of money, but you can also lose all of it if you're easily tempted and invest randomly without doing your homework. Finding good value where there's none can be a tricky thing, especially if you plan to hold on an asset for a while, hoping for a possible surge in the market that can provide quite a huge payday. Before placing all your commitment in a particular option, reviewing the stock's fundamentals to monitor its viability and considering your own portfolio are important things to do, which is why analysis and strategy are important things so you can safely and reliably invest your money. In this video, we're taking a look at 10 important things you need to know before investing in stock. Before we jump to it, don't forget to click the like button, share, subscribe, and press the notification bell for more updates. Number 10. Have realistic expectations. Being hopeful and thinking positive when it comes to your investments isn't wrong practice, but you need to base your financial goals on realistic expectations. Just because a stock has guaranteed more than 100% returns in recent years doesn't mean you should always expect the same kind of return from the stock markets. Monitoring your investment with periodic reviews can help you assess whether any important occurrence in any part of the world may have an impact on financial market or be blindsided and lose all your money. Number 9. Never let emotions control your decisions. It's important to separate your emotion from any particular stock, as investors tend to lose money in the stock markets due to their inability to control emotions. Don't hold on to any speculative unknown stock just because you have an affinity to have it, lured by a past lucrative return without understanding the risk that may lead to suffering huge losses. Get rid of the fear and greed cycle when investing, and you'll find a path much clearer in terms of understanding how the stock market flows. Number 8. Accept the substantial risk, especially for short-term investments. While stocks are often viewed as a safe investment strategy in the long term, nothing is still guaranteed. The market can be volatile, especially in the short term, and can suddenly turn when you least expect it. There are other options if you're investing your money in the short term that are more reliable and low risk. Investors should be cautious that when it comes to investing in the stock market, nothing can be sure bet. Doing a proper risk assessment before investing any money is ideal, as considering all the necessary factors that may affect your investment is key to not losing any of it. Number 7. Handle the basics first. If you're making your first investment, make sure to take the time to learn the basics of the stock market and the individual securities composing the market. Focus on individual securities which you are investing in and its relationship with the broader economy along with other factors that may affect your stock. It's best to understand financial metrics and definitions, fundamental methods of stock selection, trading bases, rules and compliances, as well as certain market other types. People lose money in the markets because they simply jump into it without understanding the economic and investment market cycles that can easily shift to your disadvantage. Number 6. Differentiate what's expensive and what's cheap. The price of a single share is not the right number to evaluate whether a stock is worth investing or not. A $100 stock isn't expensive and a $5 stock isn't cheap, depending on what particular stock we're referring to. Most investors often charge into the market with a preferred list of what to buy, already having a deep understanding of the stocks they've chosen, instead of just deciding what to buy based on the offering price. Number 5. Invest in what you believe in. While financial instruments can be complicated, no one invests of anything without having an understanding of these products. Only invest in financial products that you understand and can believe in, making it easier to spot possible risks that are associated with it and can properly decide on it without following advice from other people who aren't as invested in it as you are. Avoid being drawn by the herd mentality, as it's easy to be influenced by the actions of other people without evaluating the current information and the movement of the stocks without properly assessing it yourself. If everybody around you is investing in particular stock, there's a bigger chance for potential investors to do the same. This strategy tends to backfire in the long run, especially if the stock doesn't go through careful analysis. Number 4. Investing in a single corporation is very risky. With the amount of new startups and possible unicorns that pop up every day, it can be quite tempting to go all in on a promising new company with plenty of potential. It's easy to hope that it might turn into next Tesla or Apple or Amazon, but before you choose to risk it all, consider that placing all of your investment in a single company is a proposition you should never actually do. There is no way you can properly predict which companies will be an overnight success. Investing on a probable unicorn with a clear path may be wise, but placing all of your risks on one avenue makes it a bad investment play. Number 3. Spread out your investments. A common investment strategy is to invest in many different companies, which helps reduce your overall risk. In the case that one company's stock plummets, having your investments spread out protects your total portfolio, but may also involve additional brokerage fees, which in the long run may hamper your returns. Creating a well-diversified portfolio of stocks, but also avoid over-diversification, as going beyond a certain number of stocks might hamper the proper growth of your investments. Number 2. Invest only your surplus funds. Most newbie investors make the mistake of investing money they can't actually afford to lose. Investing in the stock market can be risky and may lead to potentially losing everything. It's important to decide your own risk tolerance, considering your own factors such as age, financial strengths, goals, and others accordingly, so you can weigh the risks properly. Once you've started to gain a profit, make sure you only invest your surplus funds, which you can afford to lose. Investment is done to generate more money, not to lose all your money, including your emergency funds should a sudden crash occur. Number 1. Buy low, sell high, and be consistent. More than a mantra for the stockbroker, never forget to buy low and sell high. As you become more adept and develop a better understanding of investing in the stock market, it becomes a habit that needs to be consistent. Buy when the stock is low, and almost any long-term horizon stock will prove to be beneficial investments that will generally push higher at one point or another, monitoring intently every step of the way. You don't need to start with a big investment. By starting with small amounts of money efficiently and consistently, these will eventually develop into potential returns. Over these long periods of time, you will find that your investments have grown, as well as your ability as an investor as well. What do you think about the 10 things you need to know before investing in stock? We'd like to hear what you think about them by commenting below. Don't forget to like, share, subscribe, and ring the notification bell for more.